Selling naked puts and selling covered calls are strategies that are extremely used overall by a lot of people, and me included. And I wanted to make a video to see which one is actually better. So for those who are not necessarily familiar with selling puts or selling covered calls, hopefully by the end of this video you have a good understanding of what are the advantages but also the risks of those strategies. And especially if you have a small account, because I know how it is when you have a small account, you don't necessarily have a ton of capital to allocate. You really want to make sure that what you're doing is actually going to be the most effective for your account. I know how it feels. So let's see first of all the covered call. The covered call is a strategy which consists in buying 100 shares of a stock and then you're going to sell a call against it. And why would you do this? Well, the reason you like to do this, the reason you like to buy 100 shares of a stock and then selling a call against those shares is that you want to take advantage of a potential down move. And let me explain. Let's say that you have a stock that is going up all the time and then all of a sudden you start wondering if it's not going to go down, if the stock is not going to go down at some point for a potential correction, for a drawdown, for example, of let's say 10%, 15%, whatever it is. Because you think that the stock is going to go down and you have bought shares previously, well, in that case, so as to take advantage of that bearish move, then you can sell a call, because when you sell a call, you're bearish. You ideally want the stock to go down, so your call is losing value and you're making a profit. So when you're selling a call, you're bearish. Just keep that in mind. So while you have your shares, meaning that you're essentially bullish on the stock, maybe on the more longer term, well, you're selling a call because on the short term, you might think that the stock is going to go down. So that's quite actually interesting when you're combining the two. And a lot of people are actually doing this. A lot of people are going to buy shares of a stock and then at some point they're going to start selling calls because they think that the stock is going down. But that's not the only advantage of selling a call. When you sell a call against shares that you own, you're going to do what we call reduce your cost basis. And reducing your cost basis seems very fancy, but don't worry, it's very simple to understand. Let's say that the stock that I've just drawn right now, let's say that, for example, you bought the shares around, I don't know, let's say $30 per share. And because you bought 100 shares of that stock, then in that case, you basically purchased 100 shares at $30 per share, equaling an investment of $3,000. So your cost basis is of $3,000. Okay, so you're still with me? Follow this. Let's say that you sell a call and you're going to receive a premium of, let's say, $1. And because the contract controls 100 shares, if you collect a credit of $1 for a call contract, you're essentially receiving a premium of $100, because $1 times 100 shares is equaling $100. And because you're collecting that credit, you're essentially reducing the cost of the shares that you have previously bought. So now, instead of actually having a cost basis of $3,000, because now you have $100 that you received in your account, now your cost basis is not $3,000 anymore. It's actually $2,900 because you made $100 selling that call option. And that's what we call reducing your cost basis. The initial cost of the shares that you bought is now being reduced because you're selling calls and receiving credit, lowering your cost basis. So that's another advantage of selling covered calls, because on top of trying to take advantage of a down move and because you think that the stock is going to go down, whatever your assumption is on the stock, you're also reducing your cost basis. And that's what a lot of people are considering as income, meaning that they're going to own shares of a stock, let's say, I don't know, AT&T. I'm thinking about AT&T because right now it's on a wild down move. And if you've been following the stock a bit, now it's around $25 per share, I think, when I think at the lowest, it's around $23, $24 per share, when before, I think at the lowest of the COVID crash, it was around $25 per share. So really, that stock is really going down. And I'm pretty sure that a ton of people have previously bought shares of AT&T and they have continuously been selling calls on AT&T so as to reduce the cost basis and basically get the credit every month or every quarter. And that's something that a lot of people do. They're going to repeatedly sell calls maybe every month, every 2 weeks, or every quarter. That's something that a lot of people are actually doing. Also, another advantage of actually selling covered calls is that because you own the shares, you're still collecting the dividends whenever there are dividends. Because you have those 100 shares, you are not going to miss out on the dividends. So not only you're going to earn money because you're selling calls, but you're also going to earn money thanks to the dividends, which is very important for a lot of people. And I get it. But you'd probably ask me, okay, cool. So that seems like a very, very good strategy, but what are the risks of the covered calls? So the first risk, and I don't know if we can really call this a risk, but this is something that can be quite annoying, because now let's say that you're selling a call, you're bearish, meaning that you want the stock to go down. If the stock continues to go up, let's say that is going to go above, for example, your call strike, and it's going to keep climbing up. You were wrong on your assumption. Because you sold a call and you're bearish, now your call is actually in a loss. And your covered call is essentially going to be limited in the upside profitability, meaning that you're going to miss out on profits as the stock is climbing up because your call is getting deeper and deeper into a loss. So essentially you have a max profit on the upside compared to when you only have the shares, meaning like, you can go to the moon literally and your profits are unlimited. So that's one annoying thing about the covered calls, is that by selling a call, you're capping your max profit on the upside. And another risk, which I think in the end is the real risk of covered call, is not necessarily on the upside, but it's more on the downside. When you're selling a covered call, just remember that you're still owning 100 shares of the stock. So if tomorrow a crash was about to happen, well, you're still owning 100 shares of the stock. And because of that, if the stock falls to zero, then you lost your whole investment. And that's where the real risk of covered call actually is. It's really on the downside. And a lot of people think that, for example, it's on the upside if your call gets in the money. But even if your call gets in the money and then gets a sign, then you're just going to end up selling the shares that you own. It's not too bad. But if the stock crashes and then let's say falls to zero, then you lost your whole investment. In our case, you would basically lose your whole investment of basically $3,000 or maybe $2,900 if you already reduce your cost basis by selling calls. But that's still a good strategy in my opinion. Now that we talked about covered calls, let's talk about naked puts. So selling naked puts is something that is extremely done by a lot of people as much as covered calls. I know I say this for basically every strategy, but that's the truth. And by the way, we call this naked puts because you're not going to, for example, sell a credit spread because your loss is going to be capped with the credit spread. When you're selling a put, your max loss is theoretically when the stock is going to zero. Exactly like, for example, if you were owning shares, that's your max loss if the stock is going to zero. To make you understand what are naked puts, let's take back the stock that I've just run before. Let's say that, for example, right now you're looking at the stock and this is where it is, but you don't necessarily want to buy shares of the stock right now. You're a bit worried that a down move might happen in the near future. So what you're going to do instead of buying the shares right now, is that you're going to sell, for example, a put, let's say at that strike. And what does that do is that basically if the stock continues rising, then your put expires worthless and you can just keep doing the same. Maybe sell a put at a higher strike so as to collect a higher credit. But if the stock goes below your strike price, so I said that you were right actually, it's going down. Then in that case, if your put expires in the money, you're going to get a sign at the strike price at which you sold the put at. Meaning that, for example, let's say that you sold a put around the 25 strike and the stock was before at $30 per share. Then now, because now the stock went below your strike price and now your put is expiring in the money, then you have to purchase 100 shares times $25 per share, which is your strike price. Meaning that equals an investment of $2,500 to buy 100 shares at $25 per share each. So that's quite nice because the first advantage of that strategy, which I think is really cool, is that instead of buying the shares directly, for example, at $30 per share when it was really at the top, you're going to basically lower your cost basis, lower your cost per share, and you're going to essentially being paid to wait, being paid to be patient, because now you're waiting for the stock to go down, and if it goes down, then at least you're buying shares at a lower price per share compared to if you had bought them directly when it was at the highest point possible. And this is quite nice for a lot of people. Personally, I feel this is quite cool to be able to get paid while waiting. And the reason you're being paid while waiting is that by selling that put, you're going to receive a credit. So in exchange for having the obligation to actually purchase 100 shares of the stock at the strike price, if the stock is going below your strike price, you're receiving a premium, meaning that that money is directly arriving in your account, meaning that that money is directly in your account the moment you sold your put, meaning that instead of someone who basically doesn't buy shares at $30 per share because he thinks that the stock is going to go down and he just waits for example, the stock to go back to 25, then he purchases them. Not only you're waiting for the stock to go down, but you're also being paid for the stock to go down. You're also being paid for being patient. So that's quite interesting as a strategy if you, for example, want to own shares of a stock, but you just don't want to buy them now. Maybe start by selling a put, and then once the stock goes down and you're being assigned, well, you're actually going to own the shares at a lower strike price and you will have already been paid for that. But before you actually go into your brokerage account and start, selling puts on all the stocks that you see in your trading account, just listen to this. Nothing tells you that the stock is actually going to go down. Let's say that, for example, instead of having the stock to go down like I did, let's say that it continues actually to go up. Let's say that it continues to go up and it never stops. Well, in that case, you just missed out on buying the shares at, for example, $30 per share, which was, now that the stock has gone up, it was actually quite an affordable price. And if you want, once again, to sell a put, you're going to have to go to a higher strikes, meaning that in the end, you're going to have to end up the shares at a higher price per share, which is not ideal, meaning that now to have like a good premium, you're going to have to, for example, let's say sell a put, I don't know, at the $35 per share, which would make an investment of $3,500 if you're being assigned, which is a lot worse compared to initially when the price was around $30 per share. So you see that that's actually not a guarantee that the stock is going to go down. If you're wrong, then you just missed out potentially on buying shares at a great price per share. The second thing is that your profit is also being limited, meaning that even if the stock, let's say, rises, I don't know, to $100 per share when it was at $30 per share, you're still only going to make the premium that you received in the first place. There is no like unlimited profit potential when you're selling naked puts. And for some people, that might be a problem. But so what's my view on it? What's my view on the covered calls versus naked puts? What is the best? Well, personally, I don't think that there is any better strategy, any strategy better than the other one. But if I had to choose, here's the one that I choose. I would actually choose both. And here's what I mean. Instead of having, for example, to choose between the covered call strategy and naked puts, I would actually use both, but one after the other. And this is actually called the wheel strategy, meaning that the first step that I would do is actually sell a put. I would sell a put on, for example, a stock that I wouldn't mind owning, I don't know, let's say AT&T, for example. In that case, once you sold a put, there are basically two outcomes. The first one is that if the stock rises, then your put is expiring worthless. So the put is now expiring worthless. The second outcome possible when you're selling a put is that the stock is going down. So now you're basically getting a sign because the stock is going below your strike price, so you have to purchase 100 shares of the stock. And if it hasn't gone under your strike and it has expired worthless, so just keep selling other puts until you're getting a sign. So that's really the only two outcomes possible. Either your put is expiring worthless, and in that case, just keep selling other puts until the second outcome happens, meaning that you're getting a sign. And once you're being assigned, you have to buy basically 100 shares of the stock. And now you can go on to the third step, which is sell a call against the shares. And you're essentially doing a covered call because now you have 100 shares of the stock and you're going to sell calls against those shares so as to reduce the cost basis, as we talked about at the beginning of this video. So now you're essentially combining both strategy in one, and that's called the wheel strategy. And I personally love that strategy. I think it's a great strategy. I've also made a video on the subject if you want to check it out, like more detailed video step by step with an Excel spreadsheet to track your trades. If you want to go check it out, just don't hesitate to go check it out. Maybe put a like or subscribe or something, but that's really the only thing that I'm asking. And then after that, once you have been selling calls for a while, the stock has been going down, and now let's say that your call is expiring in the money because the stock has risen up. And then once you sell calls, basically the same thing happens as when you're selling puts. Either your call is going to expire worthless, and in that case, you can just keep selling other calls until the second outcome happens, meaning that you're going to get a sign. And when you're getting a sign on a call, instead of buying 100 shares when you're being assigned on a put, you have to sell 100 shares. So the fourth step is essentially sell 100 shares. And I'm saying, of course, 100 shares because I'm just assuming that you're just trading one contract. But if you're trading two contracts, then you're not going to buy or sell 100 shares. You're going to buy and or sell 200 shares. You just have to obviously multiply to the number of contracts that you're trading yourself. But most people, I guess, that they're going to only trade one contract. So by actually using the wheel strategy, now you're combining the two strategies together. Like you're selling puts first, and then once you're being assigned, you're going to sell covered calls after that. And I think, honestly, that's a great strategy. The only thing that I would say though is that you need to really choose a stock that you're ready to own, and I'd say for a very, very long time, because you want to ideally not freak out if you're, for example, being assigned the shares. Like you want that process to be as smooth as possible and as stress-free as possible. And personally, if I want to use the wheel strategy, I'm just going to choose a stock that I'd like to own. For example, I don't know, AT&T is a stock that I'm tempted to run the wheel strategy on. However, the premiums that I'm getting right now on AT&T are really not worth it. So that might be a consideration. If you don't get enough premiums, maybe it's actually not worth running the wheel strategy on that stock. But you get my point. If you actually find a stock with good premiums that you want to own and you feel comfortable owning, then, just go for it. I hope that video was insightful. Please make good and informed decisions. I'll see you in the next video. And in the meantime, I wish you all the best.